to another financial modeling tutorial. This time around we're going to be talking about a very specific topic that comes up in mergers and acquisitions, which is, as you can see up here, why deferred tax liabilities get created in these deals. Let's go away from our simple Excel model for a second and just go over here and sort of go through why this matters in the first place, and then a couple of real life examples of where these items get created. So deferred tax liabilities are part of the purchase price allocation in any M&A deal. So here's a quick example. I'm going to pull up this Excel file that we have for United and Goodrich, which was a major deal in the aerospace and defense industry. And if you go to the purchase price allocation schedule here, you can see that they have this new item, deferred tax liability. And over here, it's being calculated, and it's set equal to the total of the PP&E write-up and then the intangibles write-up times the buyer's tax rate. So that's how that's being calculated here. And what goes on here is that in the purchase price allocation process, most of the items are going to retain their same value on the balance sheet, but some of them are going to change. Two of the ones that change the most frequently are PP&E and intangibles. The value is written up, sometimes it's written down, but it changes in some way. When that happens, the company's deferred tax line items change. Now, this is not just something theoretical. If you go to Oracle's filings, for example, they're a very acquisitive company, which is why I picked them. Take a look at their filings in any year, and they'll say something like 244 million of net tangible liabilities related primarily to deferred tax liabilities over here. So they're going through their historical deals and they're actually saying, you know what, we created 244 million of deferred tax liabilities for this deal. And if you go down, you can see that they have other references to it. So sometimes they group it together with performance obligations, convertible debt, other things, but they always have some reference to it when they talk about their acquisitions. And if you scroll down further, you can see that actually, look at this. For their deferred tax liabilities, they actually break it out by category. And they have a category here for acquired intangible assets. So they're actually saying, you know what, a lot of these are related to acquisitions. And so it comes up in real life all the time, especially for a highly acquisitive company like Oracle. The fact that these get created, what does this have to do with in the first place? Well, it really reflects the timing differences between when a company records taxes on its publicly filed income statement and its filings, and then when it actually pays those taxes. And specifically what happens here is that oftentimes in an M&A deal, a buyer will increase the value of the seller's PP&E and other intangible assets under the argument that the fair market value is higher than what's on their company's balance sheet. But when it does that, just like how you normally depreciate PP&E and how you normally amortize intangible assets, you also have to depreciate or amortize these write-ups. But the catch is that you only do that on the book version of the company's statements. Now, this depends a little bit on the deal type, so we're going to skip over that in this tutorial. But in most common deal types involving public companies, you can only do this on the book version of the company's statements. You cannot do it on the actual tax schedule that they use when they're paying taxes to the government. So that's what creates this difference and what ultimately creates this deferred tax liability. Now, this doesn't make a huge outcome in the end on a merger model or an M&A analysis in most cases, but there are a few important points to realize about this anyway. First off, it's common to get interview questions on these topics. Maybe not deferred tax liabilities exactly, but they can certainly ask about purchase price allocation. You also need to know this if you're working with a more advanced analysis. So if you're looking at an M&A deal where taxes are very important, for example, you need to know this. And then finally, it's a very common point of confusion. And I think the two most common questions we get on this topic are, number one, wait a minute, why does a deferred tax liability get created immediately in an M&A deal? Isn't it caused by differences over time, or isn't it caused by different depreciation rates or different depreciation schedules? Why does it happen right away? And then number two, wait a minute, so you just said that depreciation is recorded for these write-ups on the book version of a company's income statement, but not on the tax version. That means that the taxable income on the book version of their statements is lower than it is on the cash tax version of their statements. Doesn't that create a deferred tax asset? And so these are two common points of confusion. And to clarify them, here's what I would do. Instead of thinking about a company's taxable income or its historical situation, you want to think about its future taxes. So in this example over here, we'll get into this in a bit, but we're not dealing with anything that happened historically. Year 1 through year 10, these are all future years and the company's future taxes that are going to be paid. Now, this deferred tax liability that gets created in the beginning equal to intangibles created plus the PP&E write-up times the tax rate. Well, yes, this gets created right away, but this gets created because there will be differences in the future. So that's the first thing you need to understand about how this works. And how it works, I've sort of outlined over here, which is that if future cash taxes exceed future book taxes, you get a deferred tax liability. And the reason you get this is because you have to pay additional taxes because many of those items that you're saying are tax deductible are not in fact tax deductible, namely the depreciation and amortization on these write-ups. So you're paying more in taxes than your income statement would imply, and that's why you get a DTL. Now, if the opposite happens, if future cash taxes are less than future book taxes, a deferred tax asset, a DTA, will be created because you are paying less in taxes than the company's book income statement implies. And that's how it works. Now, over time, these tax payments will equalize, they'll normalize, they'll even out, and so the DTL or DTA goes away. And that's how it works here. So instead of thinking about taxable income or historical taxes or anything like that, think about what happens in the future. And if you're paying more than what your income statement implies, you have a DTL that gets created. If you are paying less than what your income statement implies in taxes, then you get a DTA that gets created. So here's an example, and I'm going to scroll over here and show you in Excel what happens to a deferred tax liability over time. So in this case, we have a company's operating income going from 100 to 170, and I can actually change this around a little bit. I'll say 180, 190 over there. So we have it going up by around 10 each year. Now, what happens here is that we have a write-up for the intangibles and the PP&E. So an M&A deal just happened, and this is the combined company's operating income after the fact. We're assuming they have no interest expense, no other items, so operating income effectively is pre-tax income here. Tax rate is 40%, and what happens is that this intangible write-up of $85 million gets amortized over 5 years. That's the standard period for this type of thing. The PP&E write-up, so you're adjusting the value of factories or buildings or land or something like that. You're adjusting it up by 24 million. This gets depreciated in over 8 years. So maybe this is the average useful life of a company's assets. Now, what's important here is that these are both non-cash expenses, and you're reflecting these expenses, you're allocating these expenses over time. So let's first take a look at what happens on the company's book version of its statements. This is what you would see in its publicly listed filings, in its income statement, in its SEC filings or annual report for companies outside the US. So operating income is 100 to 110, 120, going up to 190. And they deduct the amortization of intangibles here. You often see this as an expense on a company's income statement. They also deduct the depreciation of the PP&E write-up. Normally this is grouped together with other depreciation, but this is also an item. And so the book taxable income falls by a good amount, by about 20 million in the first 5 years. And then after that, the amortization goes away, but the depreciation remains about 3 million per year. So the taxable income is about 3 million lower than the company's operating income. Now, book taxes, you just take this book taxable income, you multiply by the tax rate of 40% to get that number in each year. So that's what the company's public statements look like. But let's look at its tax schedule now. So here it's pretty simple. We have a tax operating income going from 100 to 190 again, but we cannot deduct the amortization of intangibles. We cannot deduct the depreciation of this PP&E write-up. So what happens here? Well, the cash taxable income ends up being significantly higher than the book taxable income, especially in the first 5 years. And so the cash taxes, look at this, are much higher than the book taxes, especially in the first 5 years. So what happens here? Well, we have a situation where the cash taxes exceed the book taxes because some of these items we cannot actually deduct for true tax filing purposes. And so what happens here is that our deferred tax liability, it's going to start out at 44, and then each year it's going to decrease by the difference between the cash taxes and the book taxes. So we take our starting number, and then we take our book taxes over here, we subtract our cash taxes, so that if the cash taxes are higher, this is going to decrease. If the cash taxes are lower, this is going to increase. So we have that, and it goes down by 8 million in the first year, and then we can actually just copy all this all the way over and take a look at this. So by year 5, this is already down to 4 million, and then after that, it goes down to 0 pretty quickly. By year 8, which is the last year of the depreciation of this PP&E write-up, the deferred tax liability is 0, and then in the next 2 years after that, it stays at 0 and it goes away completely. Why? Because take a look at this. Our taxes, 67, 72, 76, 68, 72, 76. By the last few years of this period, they're either almost the same or the same in the last 2 years, and that's why the deferred tax liability goes away completely. So that's how to think about it, and that's a real life example of what happened. Of course, these are simple numbers, but this illustrates the concept very well. So going back to this Oracle example, when they tell you something like 244 million of deferred tax liabilities as they have listed right here, those are not going to stick around forever. Those are going to go away over time as the company's book taxes and cash taxes even out. And you can actually see evidence of this on some of their statements, because take a look at this. They have deferred tax liabilities related to acquired assets. And look at this. It's decreased. It's gone down by about 200 million from year to year. So in general, these will tend to decrease over time as the difference in book taxes and cash taxes normalizes. Now, of course, if there's another acquisition, these could go up again. And with Oracle, there frequently is. So you have to keep that in mind as well. But this is what happens for a single acquisition. So that's really it for our lesson. Now, to go back to those original questions, why does a DTL get created immediately? Isn't it created by the book and cash taxes being different over a certain period? Answer is no, not necessarily. It can be a cause. That can be a cause of this, but they can also be created by events that change a company's future tax situation. So it's not about past taxes. It's not about taxable income. It's about how future taxes change. And if that happens because of a single event, then these get created at a single time, and then they change over time as the taxes even out. And then the second question, wait a minute. The taxable income for book purposes is lower than it is for tax purposes. Doesn't that create a deferred tax asset? Nope. Because the relevant question is not the taxable income and how that differs, but how the future taxes themselves will differ. And so if the company pays more in cash taxes than book taxes in the future, as a result of these write-ups or any other changes, then a deferred tax liability gets created. If it's the opposite, a deferred tax asset gets created. So that's it for this lesson. Just to recap, this is important because these come up in any M&A deal. You'll see them frequently in purchase price allocation schedules. They reflect timing differences, and specifically when a buyer writes up PP&E or other intangible assets, it cannot deduct depreciation and amortization on that for tax purposes, but it will list that on its income statement. And effectively, as a result of that, it ends up paying more in taxes in cash terms than its income statement implies, and that's what creates this. You saw how it worked in our Excel schedule earlier. So now that you understand this concept, what do you do next? Well, keep it in mind for interviews. Very common question, even in entry-level interviews. And the next time you see a deal announced, do what we did. Go and look up the company's filings. Go and see if you can find a reference to it. And then go and do your own back-of-the-envelope estimate and say, okay, let's make some assumptions. Let's see what the deferred tax liability comes out to. And then let's see, based on the buyer's tax rate and the percentages, the amounts here, how it will change over time. And that'll give you some additional practice that you can use to understand this concept.